Why are some companies valued at 4 times EBITDA while other companies are valued at 10 times EBITDA? In the next 10 to 15 minutes, we're going to walk through the precise value spectrum that the vast majority of private equity and acquirers use when valuing businesses, so you know exactly where your company sits. I'm Arthur Petropoulos, managing partner and president here at Hillview Partners. We're a lower middle market investment banking firm, helping companies typically generating about $1 million to $20 million a year in pre-tax profit or EBITDA to sell their companies or secure capital. And so, we're going to share the screen again in today's video, and as you can see, we've got a bunch of blue blobs on the screen covering things up. But the idea that we want to dig into today, or the concept that we want to shed more light on, is EBITDA multiples. This is kind of the fundamental aspect of valuation for a business. There are other variables, namely two other variables, that enhance or differentiate value for businesses in a large way, which we'll get to towards the end of this video. However, EBITDA is going to be the largest driver. And that being the first variable of the three, we'll write this out here, are fundamentals. For shorthand, we'll just write EBITDA. But the idea is that the profit generation of a company is going to be a large driver of its value. And so fundamentals, the Tim Duncans, the Larry Birds, perhaps the lesser exciting components of valuation of a business. However, this is the true core, and this is how private equity or any other acquirer tends to value businesses. And so if you think of the valuation of a business, and we talk about EBITDA multiples, that is a multiple that is applied to the pre-tax profit of a business. And so naturally, any chart looking at this is going to look at a y-axis of EBITDA multiples. And so if the lowest is 0 and the highest in the lower middle market range, now it can get wild to 15, 20 times, but for an academic exercise here, we'll say caps out tends to be between 10 and 12 times EBITDA. And so as an x-axis, we're going to dig through the different tranches or the different sizing of companies, how large the fundamentals of a business are, and what that tends to translate to, or what kind of the baseline value would be for a private equity firm or a strategic acquirer looking at the company. And so first tranche we're going to talk about are $0 to $500,000 of EBITDA. Now this traditionally, and still to a very large part, is kind of the business broker, Main Street type of business that is usually not on the institutional radar. Now, there are some variables, and again, when we kind of dig into numbers 2 and 3 as we progress here, we'll talk a little bit more about what could potentially shoehorn these into actionable items. So the institutional capital food chain, if you will, or kind of the traditional lower middle market, we believe starts at about $500,000. And so you'll see really a discounted or lower valuation range for companies in the $0 to $500,000 range because they tend to be sold horizontally. They tend to be sold to other entrepreneurs. They tend to be sold to other people that are looking to build it up further. But again, it's not really where private equity tends to buy things or larger strategics. And so moving upward, $500,000 to $1 million, you start to get companies that are buyable in the traditional institutional sense. That can be bought by, again, private equity firms, strategic companies. And you know what? I don't get into too much detail because we're going to start showing at the bottom kind of where certain buyers start to enter the market. So if you see these verticals are going to talk about EBITDA ranges, these horizontals will start disclosing who are some of the buyers of these businesses. And so you'll see a valuation leap. You go from 500,000 into that 500,000 to $1 million range, you're going to have a material increase in value because again, now it's not someone looking to necessarily make their income, but it could be a larger company looking to bolt on strategic acquisitions. It could be a private equity firm that's looking for something that it can build and grow. It's not looked at for the same kind of seller's discretionary earnings. And this is when you enter that kind of institutional capital realm. Values for that 500,000 to $1 million are in the 3 to 5 times range. Again, there are enhancing or detracting factors. And once you clear that million, or even when you're right about at that million, more accurately, this might be 500,000 to 850,000, but we use round numbers for simplicity. But nonetheless, that tends to be the range. Now, jumping up, this is where you start to enter the broader lower middle market. And so $1 million to $3 million of EBITDA tends to be 4 to 7 times historically. What we've been seeing lately is a bit more of, call it 5 to 8 times. And again, there are certain outliers that get you 9, 10 times as well. But for all intents and purposes, 4 to 7 has been the historical average. It's been particularly competitive these last 2 years. So I'm actually going to change this and we'll just cross that out. But say 5 to 9 times for that $1, $2, $3 million type of company. So once we're in that range, you've got a fairly broad audience. So let's start disclosing some of these parties or revealing some of them. So strategics. What we mean strategic, it's a company that does a similar thing, an adjacent thing, a complementary thing. You manufacture stuff, they distribute it. You manufacture these things, they manufacture other things. You manufacture some of these things, they manufacture a lot more of these things. It can be something or someone that serves the same audience. It could be someone that does similar things that make sense. Hey, you clean laundry, we fold it. But the idea is a strategic is an operating company that does a lot of different things, but an existing business that could want to buy your company, again, because of numbers 2 and 3 in particular, but also just to get larger. So fundamentally, the fundamentals of your company could be interesting to a strategic just because they want to buy some more of what they already do and do well. Now, the next category, we say lower middle market private equity. Again, 500,000 to $1 million is likely to be an add-on or a bolt-on. $1 million to $3 million for lower middle market, search funds, things of that nature. That is going to be more of platform territory. And again, that means whether they're going to buy you as kind of the company to build around, or if they're going to build you to add to something that they're already building. So again, as mentioned, search funds. Search funds are basically deal by deal acquirers. So if private equity has a committed fund that is going out and buying businesses, a search fund is something that more or less is kind of capitalizing or raising capital to buy a specific company one at a time. They used to call them independent sponsors, fundless sponsors. You'd hear different phrasings for it, but that's what that typically means. All right, let's jump to the next vertical column here. And we say 3 million to 5 million of EBITDA. Now, again, we've seen an uptick in valuations over the last year to 2 years in this range as well. I think it'd be more accurate to say 6. And, it's tough. 5 million it's still going to be kind of down the strike zone. I'm not going to say 10 just yet. I think it's the bottom end of that spectrum has gone up a bit. The top still tends to stay, sub double digit EBITDA. Maybe if you're a $5 million company and you have some of these other variables, again, outliers, but down the strike zone, kind of baseball is going to be 6 to 9 times. A lot of $3 million companies are going to sell for 7, 8 times. Again, depends on a lot of different variables, but that's generally what we see. Now, 5 to 10 million of EBITDA gets you to 6 to 10 times. And 10 times is an important multiple for us because this kind of sheds some light on private equity's strategy. They go around and they buy companies at 6 times. Like, right, the historical private equity loved buying $1 million of EBITDA. So they'd buy $1 million of EBITDA 6 times, right? So they'd buy six $1 million EBITDA companies. So you have 6 times $1 million. So they're buying each for $6 million. Now let's multiply that by 10 of these companies. So let's say they paid 6 times for $1 million of EBITDA and did this equals $6 million per company and did this 10 times, you would have a purchase price on the aggregate of $60 million, right? And then what they would do, not going to win any drawing contests here, is they would take the $10 million of EBITDA that they had collectively, right? And draw that line here to this 10x, and they'd sell it for 10 times it, right? So 10 million of EBITDA at a 10x multiple equals $100 million. Now, there'd be some growth of the company in between, there'd be some integration, some synergies, some efficiencies extrapolated from things. And so sometimes even more valuable, but that is, call it multiples arbitrage is the phrasing you will hear in private equity, but that is the thesis of the vast majority of private equity. Now, again, lots of operational elements, lots of enhancements, optimizations, but at its core, it is buying companies at a lower multiple and going to a higher multiple. And the reason why, if you say, hey, well, how does that make sense? Well, the cost of capital for each tranche is different. And so someone buying $1 million EBITDA companies, smaller private equity firms, have said to their investors, we'll get you a 20% return. And so again, there's some appreciation built into these things. And so that's why they can pay 6, 7 times for things, but still 5 times would be kind of 20%, right? 5 times something is effectively a 20% implied yield. So if you paid 5 times for something that made you $1, you paid $5, you'd get it back in 5 years, right? Whereas capital for 10x type companies is going to be closer to 10%. So the larger private equity firms right now, think of Blackstone and KKR, people in that realm, they're underwriting deals to say 12%. Yes, that is a two. And so they can pay a lot more for something because their job is to put capital to use. Remember, private equity's job at its core is putting capital to use. And so that's kind of how we think of that. And so lastly, really reveal the highest rung here. Once you get over $10 million of EBITDA, you're talking 12x. We've seen 15x, we've seen 20x, but it gets very frothy. And that's kind of the where people want to be and why they grow these things largely in the first place. And so no surprise, your biggest acquiring base is going to be strategics and middle market private equity firms for really everything kind of between $1 to $10 million. Now, it is a bit of a Venn diagram. You will have middle market private equity here, you'll have strategics here, and a lot of the strategics will actually be owned by middle market private equity. And this can really be kind of a sweet spot. Draw a miniature smile there on a snowman's belly. But the idea is that can be a real sweet spot for buying a company are the middle market private equity firms that are owning and looking for bolt-ons or kind of adjacent platforms for existing strategic companies. And then lastly, we have family offices. These tend to be families that have made their money in particular industries that are looking to buy companies. They tend to like to buy bigger things. They tend to like to buy companies in the industries that they fundamentally earned their money in or related ones. However, it's a fairly broad pocket of things. They have started to kind of go downstream a little bit size-wise, but we still see them kind of adjacent to middle market private equity. And so as the kind of final reveal here, two other items we want to highlight is this is how fundamentals work. This is how EBITDA multiples work. This is why people pay different things at different junctures. This is kind of what we're seeing pricing look like at this juncture. But two variables that will either enhance or detract. And so we say companies sold on three things. We have a three-legged stool. The fundamentals, F for fundamentals, is number one. Number two, access. We've discussed that in many videos in the past. This is going to be who do you serve? My wife will remind me if I spelled this wrong, but my 6-year-old daughter will too. But access being who do you serve? End markets, demographics, geographics, particular industry verticals. If you have access to some customer base that someone else wants, that will be a material enhancement. And the second enhancing characteristic, and what we say is kind of the third leg of the stool of value of a business, are capabilities. I'm not going to spell the whole thing out. There we go. Capabilities are what you're able to do. And so, again, if we have this bar stool here, each of these, it's just getting worse in the drawings. Each of these contributes. What do you do better than somebody else? What can you uniquely do that someone else cannot? And what this all boils down to, and as we drew it last week, is you have a company that has strong fundamentals. Think of fundamentals as your ticket to the dance, right? But what the other variables are is the missing puzzle piece. And so if the fundamentals gets you the discussion with this party. So, right, company will talk to you because you have sufficient fundamentals. That's the acquirer. Now, access and capabilities serve as this missing puzzle piece. And someone says, wow, I can, and again, kind of on a thesis level, I can buy versus build. That is the magic words for enhancing value. If you can get someone who is already going to do something, but they were going to spend resources, take a lot of risk, and do all these things. If they can buy you versus build it themselves, they will always pay a higher premium. I'm running out of screen space here, but we wanted to dig into a little bit more of how do EBITDA multiples work? Why do companies value you the way that they do? Where do you likely sit? And why are some companies worth 4 times when other companies are worth 10 times? The answer, companies sell on 3 things: fundamental, access, capabilities. Fundamentals are the first bullet point, the first dart that hits the board. The EBITDA multiples, the access and capabilities either bring that up or bring that down. And so, yes, are there companies that make $1 million of EBITDA that sell for 25 times EBITDA? Sure. But similarly, there's companies that make $10 million of EBITDA that sell for 4 times. And so understanding where you sit within this realm is going to give you more leverage in ultimate conversations. But just to give you a little bit of a behind the scenes, how we at our firm look at this, how we position companies, what we've been seeing, and what we achieve for our clients, is a little bit of insight. So I hope the weeks continue to go well for everyone. Keep pushing forward. God bless. We'll see everyone next time.